So this is fundamentally, Vineet, we do not treat it as a specific, like a question and answer kind of a thing. This is Entrepreneurs of Bharat series where, as I told you, we are targeting bootstrapped entrepreneurs who have done it the hard way. And there has been some triggers which made them become entrepreneurs, and they have gone through, not to dramatize it, but they have gone through a lot of what you call experience before being there, and they have been they've been there, not given up. And exactly, I think this is where we also felt it was good to have someone like you who has fundamentally you have been the flag bearer of this kind of impact investing, not just looking at metros in India. And someone like Raghu who has seen that happening at a very what you call advanced stage in the Bay Area, and how we could get some of the nuances about what a startup should look at if someone starts now. Because fundamentally the challenge today is, if we look at it right, so people have too much of information linked in, there are too many investors, there are too much of people who give gyan, and everybody wants to tell this is the right way. So this is the whole context. And for our audience to uh, just to, I think it would be not right if we don't introduce Vineet in a small way. So fundamentally, he has been the guy who I like the story of being in a forest service and then becoming fundamentally helping startups in India. And it cannot be just a VC story, right? As you rightly told, you also have more than that in the Avishkar group itself. So to start with, Vineet, so what I would like to ask is, like, when we talk about ventures itself, even if you go back before Silicon Valley, right, even before the Wall Street, haven't civilizations always rewarded those who took asymmetric bets, be it from a trading community to kings backings, warriors or something? How do you see this specifically to start with? And then probably, yeah, we can.
Yeah, no, so entrepreneurship is actually, I mean, it comes from entrepreneur, which is you venture out, take risks, do things. For the venture capital, Columbus' adventure to discover India was funded by the Spanish crown, and that was also venture capital. So, and so I had the lucky opportunity to have Vishnu Varshney on my board. Vishnu Varshney is considered the father of India venture capital, the first venture capitalist from India, or at least the first Indian who started venture capital in India, founder of Gujarat Venture Fund Limited. He used to be on my board, and I think there are many and many stories from movies to religion to history to discovery of new continents. But I think, and I think we have Raghu probably is going to explain in a much better manner what Silicon Valley is all about. But if you look at venture capital in its new form or in new shape, the way it actually happens right now, the whole idea is to actually take extraordinary risks to either change human behavior or essentially discover something which could fundamentally alter the way we do business. So the venture capital story is not necessarily about starting a business. It's actually about altering the way either human beings interact or technology influence our lives. And so these are two things that essentially what a pure play venture capital looks at. Now, India's venture capital story and my own venture capital story is slightly different because when I started to look at what is it that an Indian entrepreneurs were looking for, and I'm going back to 97, 98, 99, 2000, and I was also trying to see if how do you, and my question was very simple. I mean, ultimately we are all solving problems. So the problem that I was solving was a very simple problem. I was in a forest, I was meeting a lot of very poor people. I was told poor people are great people, they have large heart, they are very nice people. And I was also told at my time of education is rich people are normally naughty, bad people, etc., etc. So when I used to meet in people in forest, I used to ask them, so what do you want to be? And to my great surprise, all the good people wanted to be bad. They all wanted to be rich. And so I said, either I was taught incorrectly or there's something incoherent in this explanation that poor are nice people and rich are bad people. So my whole problem statement started: poor want to be rich. Then I actually tried to ask, so how do you become rich? I come from a government family. My father was a government servant, so we had zero understanding. Nobody in my family history has ever been an entrepreneur, so of any kind, no business, nothing. We are basically a farming landlord family. My father became government service, so zero background. So I said, okay, if I want to become an entrepreneur, what do I need to do? And I realized money is the biggest missing link. So even for somebody like me who came from a reasonable background, I mean, we were classical middle class government servant, honest father, so no corrupt money as well. So really, my father bought a Maruti car in 1998. That will tell you. By that time, I was already in a job. So reasonably okay, but we were still middle class. We had a government car. We had actually a telephone at our house, and that was considered a huge, big opportunity. So when I went to banks and all, I started realizing they all want something for you to give them security. I had no security to offer, and that's when I had discovered. And then I got a lucky break. I was given an opportunity to at IIM Ahmedabad to apply for an incubator. So that's how my story started. But really, from a venture capital perspective, or any perspective, you're looking at a problem solution, and if you find a solution to the problem, it could be a simple solution, and then answer that you have to ask yourself is: do you want to build a rocket space science, or you want to be on a bicycle? If you want to be on a bicycle, then you can be bootstrapped and you can drive at leisure, at pace. If you seek venture capital, then you are pretty much going to be building a rocket ship. And I think this distinction is unclear to a lot of entrepreneurs. And that I will survive, I'll be profitable, and I'll do okay doesn't really gel well with venture capital thought process. Even though Avishkar actually tried to readjust the venture capital model to adapt to India's realities in 2000. But reality is venture capital is seeking for a 100x growth in a reasonable period of time, and it keeps getting into debate. Every time we have big failures or a negative cycle in growth, people start coming back and saying, "Oh my God, let's actually have bottom line, etc." And that confuses a lot of entrepreneurs. But that's simply venture capital is getting scared. That's it. It's not really going to change anything. So
That makes thanks, Vince. I think that makes sense, right? See the way I think you actually whatever I wanted to ask you, Raghu, you put it across, right? Uh, is it something like a different future that you want to build as a startup? And that's something that, again, since we are talking about Bay Area also, right? That's what Peter Thiel talks about. Aren't we, are you seeing, Raghu, it's the imagination with respect to the way the founders want to build is somewhere constrained by the balance sheets or the kind of things, or this is an ecosystem you have to adapt, like Vineet said, right? If you want to build a leisurely, patient kind of a startup, bootstrap it, raise family and friends around. But if you want to really go the rocket scale, you have to follow this route. So, but are the VCs also adjusting to that?
See, I think Vineet hit it on the head, right? When you take venture capital, there is an expectation that it fits a certain growth model. It's just it. And that's not the only way to build a company. There are multiple ways to building a company. If you're signing up for taking venture capital, then it comes with those strings, and that's not because somebody is sitting there and saying this is my evil plan and this is how I want to do it. It's just that remember that the VCs also, at least most of them, the VCs also are not necessarily investing their own money. They take money from LPs, and typically these LPs, limited partners, are foundations, typically university foundations, sovereign wealth funds. So there is, and these LPs are basically they're allocating risk. So VC is effectively almost the most risky among that asset class. So when they allocate some capital, they expect the VC or the fund manager to correspondingly invest in an asset which has those characteristics. So okay, so that's the expectation from the capital point of view. Now, if you are a founder, there are multiple ways in which you can, and there are some very, not just academic thought experiments, but real examples of people who built so-called unicorns without taking venture capital, successfully built them. But that doesn't mean that's the right way or the wrong way. But if you do end up taking VC, it comes with these expectations that because these are funds that have a 10-year horizon, right? So if you have a 10-year horizon, meaning the VC is taking somebody else's money, OPM, right? Other people's money, looking to invest that into the startup, and within a 10-year period, saying that they'll give back the money to the LP with some returns, with some promised returns. So you're going in assuming that in 10 years you're going to, build the company, exit the company, right? So basically, this is you're signing up to play cricket, and you can't come there and then say, I'm going to play golf. That's basically it.
It's very right, Raghu. So I want to ask you, Vineet, on this, right? See, it's a data-driven model, right? When you take bets. What is your view on an early stage? Because see, the biggest challenge I see, at least between the Bay Area ecosystem or the Western ecosystem, Indian ecosystems, is the quality of the early stage startups, which are not me too, right? So there are too many. Yes, there are problems they are solving with due respects to them, right? So when you are taking bets, do you do you even go through a belief driven model? I bet on the six, even in an early stage, or it is still a data driven model at some stage? Because definitely, as Raghu said, right, the LPs, you should still return back the money to the LPs.
So just extending what Raghu is saying, so just understand this. So there is a 10-year time frame, and we are investing for 4 to 5 years, pretty much 3 to 4 years actually. So essentially, somebody you are giving money to in first year, you expect that guy to be somewhere in terms of creating an exit in sixth or seventh year. But the guy who's getting the money in the fourth year should actually be ready by eighth year, so 4 years. So so there is a lot of judgment. So we call it a portfolio construction. You construct a portfolio where you are calling in money, other people's money. It comes at different points of time. It goes into different enterprises at different point of time. And then you expect some of these guys to become outliers or outlier in terms of success. Some will not succeed at all, and some might give you some returns. Overall, the portfolio must give a return that justifies the construction of the portfolio, which is a claim that Raghu and I would be making to our LPs that, hey, I have this special skill. I use a Hindi term. We are those guys who are Begani Shadi mein Abdullah Diwana. It is somebody else's marriage, and we are dancing in that marriage. Now, because it's somebody else's money, we give it to somebody else. So what is our raison d'etre as GP? We are essentially saying we have this unique capability to identify these bright young men and women and work with them to build these extraordinary companies, and we create this portfolio. So that's really, now each one of us, Raghu will go and tell his LPs, my specialization is, I understand technology of this kind. See, technology is also very wide. You can send a rocket to Mars, you can actually, or you say so you can either be sector agnostic, or you could be sector focused. You could be a SaaS focused investor, or you could be a pure technology. So you say, I have to deal with high tech, high growth enterprise. That's what probably Raghu will say. There are a lot of wedges. So somebody will say, I am actually a biotech focused investor. So because I come with a science background, I understand biotech, I provide specialization. Or some would say we are sector agnostic, but we'll still be high growth. Some like me will go and say, hey, I am actually trying to bring about a real change in the lives of the people, but using the same venture capital model. Model is the same. Then people ask, are you going to give me less return or more return? I think either whether it is Raghu or me, both will say we are investing into high risk with objectives of returns. Those returns are unpredictable. So we generally give a range and we say it may actually be in this range. And then our performance appraisal will be whether we are in that range or not in that range. So it's all dependent on. So ultimately, Raghu and I both are selling a story to a potential investor. The investor is looking at a return as an outcome and is looking at an extraordinary risk you are taking in your system because he or she is allocating a high risk capital. Just to give you an idea, if I have 100 rupees and I am an allocator of capital, 2-3% of that will go into high risk category or 4% at the max. So essentially out of 100, we only get 2-3 rupees. Then they will actually allocate to private equity, then they will allocate to real assets, then they will allocate to liquid and debt. So it's actually a whole allocation. We are a very small part of that allocation. And because they are expecting high returns, that's why they say venture capital, or they are expecting impact returns. Again, risk is high, but they are actually expecting some change plus some returns. So they have a profile from both of us, and we have to justify that profile through the construction of the portfolio. So then when we go and meet an entrepreneur, I will always say, hey, do you make an impact? And probably Raghu will go and say, hey, do you have something extraordinary in your technology? You can't just be actually using Excel sheets and making something up. There has to be something. So what is that deep tech? Now, in our case, in Avishkar's case, we earlier started by saying, is there some element of technology? But how does that technology makes a huge difference to the people from the lower economic strata? And because we were sector agnostic and technology agnostic, we always looked at everything. So can you create a dairy in Odisha or Jharkhand? That is now, there is no great technology discovery there. Technology is all known. 1940s itself, we knew how to actually pasteurize milk. But in Odisha and Jharkhand, tribal population, limited milk, big demand from monasteries. So you can create a huge value chain that can create significant impact on the lives of poor people living in the villages. At the same time, make available different kinds of products. And so you can build a brand, you can create a big impact and probably generate returns. Now, so this was also fine with me. On the other side, I was also actually trying to create agri-techs. There was no investment in agriculture. We realized technology is going to play a big role. So we also said, okay, is there any smart entrepreneur who has some technological capability to disrupt how agri markets and farmers engage with the markets? So agri-techs. Similarly, we looked at many other things. So climate tech is another area. Agri-tech is one area. Then you looked at, so I worked with Fab India. So we said, oh, there is actually production in villages, sales in cities. That's actually a great model because you are now taking production back to what Mahatma Gandhi wanted. Then we realized there are some amazing problems. For example, you cut your wheat and maize and then you don't have storage because India's warehousing system was designed for traders. It was not designed for farmers. And traders will therefore come and bargain because rain will come and that will destroy the crop. So the farmer has to sell. They have no liquidity, they have to sell because they don't have any storage. And the storage is at least 10 tons. 10 tons is too large for an Indian farmer to produce. The trader will come, buy, take that and put it into a large warehouse, which is 20,000 ton warehouse next to a city. Now, how do you take a warehouse to the villages? Well, it's just commercially unviable. You can make it viable if you can bring an element of technology. Now, I'm telling you a story where we started seeing technology can solve problems that are completely not solvable in any other form. So you create a 2,000 ton warehouse in the village and basically digitize every bag of wheat that comes in, digitize it, and then trade this on a digital platform and basically create a relationship with the farmer where the farmer account is connected. And if the farmer makes a choice to sell their bag, you can have 20,000 farmers each with one bag, creating 20,000 bags. Now you have created a lot and you have essentially sold that lot and credited each farmer for a one bag of sale without actually doing it. Because otherwise it is impossible. You can't really find 20,000 farmers, put them together. So then people have solved, and this is actually where technology plays a role. Without technology, without the Jan Dhan Yojana, which actually created all the bank accounts, without the payment systems, without the technology, without penetration of mobile phones.
Right,
None
right.
of this is executable. So you then used a beautiful technology where, of course, government played a fairly large role in creating the infrastructure. But you use that infrastructure to create a technology that solved a problem that seemed unsolvable. So there you have made a huge difference. But again, financial returns here would always be questionable compared to the impact that you have generated. And that's why a pure commercial investor will find it incredibly difficult to invest in this company, while an Avishkar would be very happy to do it because it is delivering extraordinary impact. I may still deliver a 5x, 6x return, but the probability of the return when I'm investing in it is very low. When I try to make the judgment, the risk far outweighs the potential of the return. When Raghu has to make an investment, he's making a pure commercial investment. He has to say, if I succeed, the risk has to actually be proportionate to the reward that I'll generate. While in case of Avishkar, we might actually sometimes take disproportionate risk to deliver uncertain returns. And those returns could be high, could be low, but uncertain. In case of Raghu, he will say, I'm taking disproportionate risk. If success happens, disproportionate reward. So it could be 1000x returns also, 100x returns also. In my case, disproportionate risk, the reward is only 5x in case I am successful. So that compromise is where impact investing and mainstream investing diverge. And that's why the pools of capital are also slightly different.
No, I think just to get a common understanding with Raghu, again, the returns might vary, but still the return has to be given. It is still not an NGO. You still have to give. Second, yes, today in India there is a framework, be it with UPIs, but still the fundamentals still remain the same. There has to be a problem. Technology comes second. What problem you are solving, and I think like Vineet said, do you? Has there been? I think probably Vineet, if you can give your thoughts, and then Raghu can add. See, we cannot directly apply a sandhill road kind of a framework from Bay Area to India to a Sangli fundamentally. Now, if I look at what you guys have done, right? So fundamentally, there has been a deep knowledge of the areas with respect to tier 2 or the problems in regions, and then probably adaptations. So how, but still, again, even though the returns are less, still it's a VC impact investing. The impact is still there. How much of adaptations do you do from a regular framework? And do you see the startups also doing that similar adaptations when they are venturing to impact?
So, Pavan, I think we first need to understand that the venture capital model is a very ecosystem driven model. Okay. So, if you look at Sandal or if you look at Silicon Valley or Bay Area, the uniqueness is money, talent, and technology and infrastructure. This comes together very beautifully. Even in US or anywhere in the world, we have not been able to replicate that uniqueness. So there is academia, there is talent, there is capital. And remember, the capital in Sandhill is actually benefited. Those guys have actually seen the value it creates by taking those risks. So you need to have a lot of success stories that has to reinforce people's ability to take risk. India is in a very early stage where our ability to identify, to see big success coming out of the extraordinary risks being taken still remains limited. See, for us, the story was Infosys. Infosys was the great story that was inspiring everybody. And we are only now we have 100 unicorns, etc. But you keep seeing these unicorns coming and then they vanish as well. Because unicorn remains a mythical animal. Whether you like it or not, it is a myth. Value creation is when you essentially liquidate your assets. So I can create a unicorn, but if I can't sell out of my unicorn, then it may actually become zero again. So two things that where India has I am seeing a lot of challenge in India is we have oversold the story of becoming rich fast. Entrepreneurship is not about becoming rich fast. It is not there in Silicon Valley. It is not there anywhere. Entrepreneurship is about the joy of creating something, solving a problem or creating a new outcome. Either ways, doesn't matter you are doing impact, non-impact, tech, you will always, and I think when Raghu looks at it, Raghu will never actually give money to a guy who says, I want to be a billionaire, please give me money. That's not how you make decisions. We always ask, do you have a problem? Have you identified a problem? It could be anywhere. It may have impact, it may not have impact, but you are solving a problem. The problem, when successfully solved with whatever technology, whatever the idea, whatever talent you're using, should be able to build a very large company, and keep scaling now. And the booster is the liquid propellant, gas propellant, whatever you want is money. So money is essentially an additive for allowing you to build a big dream using technology, talent, and the infrastructure that has been provided. Now, Silicon Valley is that beautiful and unique infrastructure that we have, to some extent, in a smaller way, have replicated in the Bangalore area. That's essentially the only place where you have some level of replicability. Now, my problem is, when I actually do this, I am trying to replicate Bangalore in, let's say, a UP or a Bihar or a Jharkhand or even rural Maharashtra or rural Bangalore, rural Karnataka or rural Tamil Nadu. That is very difficult to do for many reasons. For example, infrastructure is not great. Now, because of the jam trinity, you actually still have some level of infrastructure, but talent is not available. I mean, come what may, the best talent from Eastern UP will always be in Bangalore. It won't be in Eastern UP. It won't be in Varanasi. It won't be in Patna. So I have to deal with some very unique challenges. I am trying to create a great company. So I created a bank in Banaras, which is now $3 billion in terms of assets. Now that's quite extraordinary. But it has taken us 15 years to build it. Had we only focused in Bangalore, probably we would have done. Had we focused on rich people towards that bank, the bank would have focused on rich people instead of poor, probably would have reached 20 billion by now. So there are unique challenges. There are other unique challenges that are related to regulator and the government's understanding of who the poor are. And poor is actually a very important political economy. Remember, rich do not vote in as many quantity as poor do. So poor are always a political community. So when you are trying to help the poor, you are also taking the risk of getting embroiled into a political economy that no sensible investor would want to do. So that's another risk that most investors worldwide don't understand, is what an impact investor is taking. I am taking the risk of dealing with the political economy. I am taking the risk of dealing with a talent parched environment and trying to solve that. So essentially, therefore, the most important and the beautiful thing to happen, where impact investing diverges away from mainstream investing, is we are going into broken ecosystem. While Raghu is duty bound to actually operate into the best ecosystems, because his money, the capital, is demanding that from him. My capital is demanding me to actually do things which are not necessarily in the best ecosystems. And that's where my risk becomes a little extraordinary risk. Again, a different way to just explain. And also the political economy of the game.
From a VC's lens, the founder should start thinking from this perspective, especially when they are trying to solve a problem. See how early are they into product market fit? Do they need to really solve that problem? And then probably, if again, I'd like to come back to Vineet in terms of the personality of the people that he has been seeing and how it has evolved, especially with the AI age. But your views on the product market fit, especially because that becomes a critical factor, be it with respect to impact startups or this. Uh, is there an impatience? And like Vineet very clearly said, right? It's not about generating quick wealth, right? So are the patience levels waning as you see over the period of time? Yeah, Raghu. Yes,
So this is to you, I think.
Raghu. Yeah.
For me, see, I'm not sure if the patience is waning, but this is an ecosystem play, just like Vineet is saying, right? It takes a long time for these ecosystems to form. And just think of it as a very efficient way of connecting all these stakeholders. So there is the capital person who provides capital. There is the person who builds something, and then there are person or ecosystem, sub-ecosystems that take those products and services to the market and all of those things, right? That you want it to be as frictionless as possible, including the capital coming in and driving that engine. before, so even like I want to say maybe 10, 15 years back, that wasn't as efficient as it is today. Meaning, um, it was very difficult for somebody with two or three parts of this ecosystem to get capital. Or if somebody had access to capital, they didn't have access to the market. Or if they had access to the market, they didn't have the infrastructure to build something that could consume the capital and then get them into the market. So these are parts that have to come together. But once it comes together, it becomes super competitive. And you want it to be competitive. You want the best ideas to win, as opposed to somebody sitting, you don't want it to be centrally planned, basically, which is how it was, right? Meaning somebody sits in New Delhi or the state capital and decides, I'm going to allocate capital to this, I'm going to allocate capital to that, without, I mean, even now people don't have a systemic understanding of where the capital should be allocated. I mean, we have some macro understanding, but it's very difficult for somebody detached to say this is what should be built. So why I'm saying this is, if okay, this is all from the ecosystem or from the capital side of point of view, right? But if you are a founder, I would almost forget all of this. See, what's your call to action, or what do you want to do? You want to build something that fundamentally meets a need that you think is unsolved right now, and it is an economic opportunity, no question, right? It is an economic opportunity, but you want to go meet a need that you, for whatever irrational reason, think that you want to go build some product or service to meet that need that is not being met currently. Everything else, and you want to do it in the most efficient way, right? Everything else is fluff. Everything else is literally fluff. It's like, don't even bother uh, trying to solve it or trying to understand it. Well, you want to understand it because you want capital and you are competing with other people for all these resources. But your only thing that should bother you or keep you awake at night is, I want to go build this thing. I want to go provide this service to this segment of the population. And how can I do it most efficiently so that I can also capture value, I can also provide value, and whoever else is participating in the ecosystem along with me also get to share that value in the most efficient way. If I don't do it in an efficient way, somebody else will come and eat my lunch.
So, Vineet, this is something that I wanted to ask you was the founder's personality. Again, with my limited experience, we see again Dilip is there, so probably we have a team in Udupi. We see the passion, we see the commitment and the dedication more in the tier two in India, especially with what we call Bharat. There, do you have you seen that difference between the metro startups doing impact startups, or fundamentally the people there who have seen the problem there, they are better off doing it, and everywhere, because technology has to be used. Some see, just because we talk about it, right? People want to force fit AI, force fit a blockchain to it. How do you see these personalities, and what is your view on that?
I think, Pavan, one of the biggest challenge is when entrepreneurship get democratized, which is what it has, because everybody want to be an entrepreneur. You have these kinds of problems. So you have copycat entrepreneurs, copycat ideas imported from US to India, and so again, hunger is a very natural thing. It's not about poor are better, yeah, tier two is better, tier one is better. It is a natural thing. You can come from the richest family and you feel very hungry about being successful yourself. You may be from the richest family. You can come from the poorest family and you can feel extremely motivated to be very, very rich, or want to build a very different product, or want to be successful differently. So to me, tier two, tier three, tier one and metro doesn't matter at all. The entrepreneur, their vision and their drive actually stand out. And so therefore, but again, you know why capital actually goes to IITs? And this is a question. It's not because IITs actually give you the most talented people. Probably there are more talented people sitting outside in tier 2, tier 3. But talent का जो concentration होता है ना Pawan, and we are probably
Yeah.
mistaking. IITs give you a concentration of talent. Okay, that essentially makes your chances of being successful on a percentage basis higher because you are dealing with a very high concentrated talent pool. Now, if I have to find one person in, let's say, 20 crore people in UP versus I have to find 10 people among 600 in IIT Bombay, you tell me where will I have a better chance of success? It will be in the IITs, right? So I think what people have misunderstood is that, oh, the talent only is IIT. No, IIT has done a wonderful job of getting the best talent from India through its process into one place. And then for an investor, whether it is Raghu or Vineet, it is far more easier to actually go and pick the best amongst those to finance and fund. So therefore, a disproportionate number of successful entrepreneurs come from IITs because they are probably the best talented people. But there is a disproportionate number of failures also coming out of them that people have not been noticing. There is a very large number of IIT based entrepreneurs who have not been doing well. Same will apply to MIT, same will apply to Stanford because they receive more capital. The other thing that is probably is being missed out is sometimes very large supply of capital allows the entrepreneur to make so many mistakes and yet be successful. So let's say I start a startup with $1 million as capital and somebody else at the same time starts with 200 million. Now the person starting with $200 million can make 10 different mistakes and still be successful. There are stories in India where people have started with 200 million and $1 million solving the same problem. The 1 million guy has also solved at least the same scale that the $200 million. Now, of course, the $1 million guy is much better. But because the $200 million guy has unlimited supply of capital, his and her ability to actually completely go and rocket himself up at that point of time because of the unlimited nature of capital is so capital, the size of capital that is available to the talent can make a huge difference between a more efficient guy losing out and an inefficient guy actually reaching success. And therefore, capital has capabilities to distort outcomes and results. And we have to accept and agree to it. This does not necessarily mean that those who are in tier 2, tier 3, tier 4, or those who raise 1 million and don't raise 200 million should actually be feeling bad about it. Frankly, when I started off, I started with $100. There was nobody willing to invest in India, nobody willing to talk. But I'm not a failure. I have come this far. Now there is somebody who started in US or in Australia, started 10 years later, and took a more defensive approach, wanted to be in a private equity space, have raised 4 times, 5 times more money than I raised in lesser time. That does not make them more successful or be less successful. It just says that given the circumstances, given from what we were trying to do, you have different outcomes. Both are successful, but if you define your self-worth or your self-success by how the media writes about you, then the other person will always be more successful. A good entrepreneur will not waste his or her time trying to compete with somebody. Your competition is with yourself.
Right.
If you do extremely well at some point of time, you will become very successful. You will become successful in your cohort. You will become successful in your community. And then you keep getting better and compete with the world. That's really what your destiny is. But negativity starts coming in when people start becoming, and then it leads to toxicity. And for an entrepreneur, avoiding toxicity is very critical and very important. And so
It's
these are some of the things entrepreneurs nearly need to understand. And this brings down to one very important question. Do not chase valuation. And very high valuation is not necessarily the real reason of your success or your failure. So valuations is an outcome. It will happen. Some of you will get more value, highly valued. Some of you may not get that valuation. It is an outcome. It is not necessarily what you should be chasing. Do not judge yourself by the value of your enterprise. That's the worst thing you can do to yourself. Of course, as an LP or a GP, both Raghu and I would want the highest valuation, the best exit. But for an entrepreneur, it's a very bad positioning
Right.
as a VC. And remember that both Raghu and I will not really be negative on an entrepreneur who is actually building a good startup. A good startup, we believe, will give us a good exit. And there are many other things that play around in value creation. I can also tell you, money sometimes is crazy. It wants to chase EV. It doesn't matter you have built the best ICE engine. If the money wants to chase EV, the EV guy with a bad product might also actually become a multi-billionaire. So do not underestimate the power of capital in creating value.
So I think just a quick, yeah, Raghu, yes.
Yeah. So maybe two quick points, right? I think this is probably the most interesting takeaway, at least from my point of view. See, the entrepreneur or the founder is the one who knows the market way better than the VC. It should be that way. So if you're building something for the VC, it's a terrible way to build a startup. And typically for two reasons. One, the VCs are excellent at pattern matching and chasing fads, right? So the whole herd mentality that Vineet is talking about, and it kind of goes in waves. And I don't want to say all of them are like that, or I don't want to say they don't understand, needs of potential customers, but sure, they don't understand it as well as the entrepreneur does, or they should. The entrepreneur should understand the customer needs way better than the VC, right? So you already have a sort of built-in mechanism for who is the one you should be listening to. So don't have the founder go on. So that's one. The second is, VCs are excellent in predicting the past effectively, right? Meaning you can talk a lot about this is what happened in the past, but that's literally of no use, right? By definition, you as a founder, even in an existing market, you're trying to go build something that doesn't exist. So to expect the investor to give you signals is just a terrible place to be, because they're just awesome at predicting the past, have no clue about the future.
So I'll paraphrase Raghu in my own ways. One of the things that I always say to an entrepreneur, the day the VC tells you what to do, you are a write-off. So the entrepreneur's job is to know what they are going to do. VC's job is to tell them what not to do. The reason why we are capable of telling what not to do is because of the pattern matching, of understanding what will not work. Because we have done 100 times, so we know this will not work. So if you are barking up the wrong tree, we can tell you. But what to do is purely an entrepreneur's area. So markets, only entrepreneur understand. If I start understanding it better, I should become the entrepreneur. So when I start telling an entrepreneur what to do, the VC is out of their depth. It's a wrong place to be. The entrepreneur should never ask a VC, what should I do? The VC should never tell an entrepreneur, but entrepreneur should always ask, should I not do this? And VC should have the right to make an opinion. For example, do not try to have HR policies that are very unique. I have come across some very bright entrepreneurs who want to change the world by having new HR policies. Now that is stupid, because you are already fighting for solving a very difficult problem. Why would you want to bring in new elements of things that's all done? Why would you want to reinvent the wheel? So VCs are very good in telling you how to look at your finances, how to deploy your capital. One of my companies went bankrupt because the CFO thought he's too smart. He actually put all the capital into markets, and destroyed. So suddenly one day we woke in FNO. Can you believe it? The CFO put in the money, saying these morons are putting money into our business, which is going to be very difficult. Who knows, 7 years down the line, I will put money in FNO, and in 3 days I will deliver more returns. Well, he delivered a big zero. The company went bankrupt overnight after raising 10 million from 9 investors, or 15 million or 20 million, something like that, some ridiculous number. Six of us had put in, and this is all the top investors in India and global investors. So there are two global investors, Avishkar, and three Indian investors, and the VC. And now this is absolute suicide. It was written very clearly, the CFO is too high risk. The CFO needs to be replaced in our memos. We had asked the promoter to replace the CFO. The promoter did not replace the CFO because he genuinely trusted him. The CFO drove the company. Now, this is not something an entrepreneur should do. So very critical and important to understand. The entrepreneur should know what to do. VC's job is to tell the entrepreneur what not to do, and that's the partnership. And the second thing is, entrepreneurs and VCs will always have a healthy skepticism. Our job is not to become the largest running company. Our job is to invest and exit. And because we have to exit, while the entrepreneur will continue on the path, there will be some friction. And entrepreneurs need to inherently understand that this healthy skepticism has to exist for a good entrepreneur to succeed. So these are some additional things in addition to knowing your market: how to manage a cap table, how to manage VCs who have different exit points, how do you actually look at, and again, one final point which is very important for entrepreneurs to understand: valuation is useless because there is a term called liquidation preference. Almost all of us use it. The moment we put in liquidation preference, which essentially means I get a certain amount of my capital back, either it is 1x, 1.5x, 2x, before the entrepreneur gets $1 back. So if you are successful, great. But if you fail for some reason, that valuation that you are so excited about may not mean anything. So it's very important and very critical for entrepreneurs to understand that when you are taking capital, and if you are utilizing it in a certain manner which is not productive, you are essentially the only person who you are going to damage is yourself. Because that misutilization of capital is going to damage every potential dollar that you were supposed to make, or rupee that you were supposed to make down the line.
Just a quick point considering this. One is on the, we have just to strike off or tick mark some of the things in the market which we have seen or something. So some where you raise the money, your focus is still going on raising the money. Now the problem here is I will give a return by expanding in the global market, and I go to my VC and show some 10 million, 20 million revenues when I'm still doing pilots. Do you go and have you come across such more often, or it is like, yeah, there are a mix of all these people, or it's just an average?
So Pavan, the example that you're giving is a ethics problem. Okay.
I was coming to that. Yes, exactly. So
Yeah.
are we being realistic? Yeah.
Yeah, no, so that's a morality problem. And there are two kinds of entrepreneurs, three kinds of entrepreneurs. There are entrepreneurs who are very conservative, who will go and tell them, I'm doing a pilot. And a lot of VCs may not appreciate that honesty. So
Exactly. Yes.
there's a dual side problem. The entrepreneur is being extra honest, the VC is not so interested in that amount of honesty. Then there are second kind of entrepreneurs who are telling you the truth, but with the spice that VCs like. That's the right entrepreneur.
Right.
Should be able to at least create the amount of excitement on the other side, because ultimately it's a marriage, right? So if you're a
Right.
purely plain vanilla spouse, nobody's interested in. So you have to do some makeup. So nobody's saying it. But you cannot actually become somebody else. You can't start lying that you are bald, but you got put on a wig. At some point of time in the marriage, you will discover that you're bald. So you cannot then say, I've got the best hair in the world, but of course you don't have it. So that's the third kind. That's, I think, an ethics and morality issue.
Yeah.
The third kind is a complete no-no. Okay. The first and second kinds are the only ones that we deal with. The second ones are the ones who actually excite more VCs. Therefore, we'll deliver better results. Because whether we like it or not, when you're trying to build something at a very rapid pace, you have to constantly raise capital as well.
Right.
So, in having a great vision, a great idea, if you do not have the ability or the flamboyance to raise capital along with it, so either you bring co-founders who have that flamboyance. So that's actually an equally critical ingredient, because if money is important and you fail to raise money, then you are dead.
Right.
So, so you cannot say that I will not raise money. The money should find myself. I am so good that money should find itself. In 1 out of 100 cases, it might happen. I'm not saying it
Right.
doesn't happen, but then you have put in all the onus on the VCs for your success. How
Yeah.
does it make you very smart? So that's why I'm saying in the number one, the first category, very honest, very transparent entrepreneurs. Uh, if they are very honest, transparent, a large number of VCs will still love them, but a lot of VCs will probably not love them as much. If you are very transparent, honest, but you can bring some level of flamboyance to the same presentation, some of those very honest entrepreneurs actually think that flamboyance is also actually not necessarily right. I don't see that as wrong, frankly. The wrong is when people actually are compromising or in the truth. There is zero compromise possible in being factual about what is fact. So you cannot actually be factually incorrect. So
Yep.
again, I'm saying fact has to be fact. There is no opinion. I thought this may happen. That is not. Between one and two, facts have to be absolutely accurate. You cannot not be factually correct. So if there is 1.01 gap into your factual correctness, you are unethical in my view, and that really is where the lines are drawn very hard. In India right now, a large number of entrepreneurs have not yet understood
Yes.
that if you don't have the intellectual property rights and you are thinking that, oh, I'm smart, I'll figure it out, then you are taking GP's capital by misleading them. If you are actually piloting and then you are telling them that this is not a pilot, this is real value and that I'm generating, then you are being unethical. And ethics and flamboyance are two different things. So I'm saying facts cannot be disputed. If you are saying, again, facts is all about past, okay? Future is predictions. You can go wrong in predictions, but if you are falsely predicting the future and or you put in a certain number and then you then try to cook those number up, that is extremely dangerous. You made predictions, you missed those predictions, be very transparent and upfront and say, sorry, I tried but couldn't succeed. I think most VCs are happy to take a 80% cut in your production, in your predictions, because you failed, but you have to be very honest. You cannot be dishonest. It's the same thing as marriage. You cannot be dishonest about your features, your capability. So anything that is factual, if it is misrepresentative, then you are in dangerous territory.
See, I think one thing I've seen that so this was gold dust from a founder perspective, right? So one of the things I've seen on the investor side is there are, and I've seen this too frequently for my own comfort. Investors are insisting on financial models from a very early stage company.
Right.
All that they are proving is the founder can do math, very basic, not even high school. It's like middle school math, and that's useless. I mean, if an investor is insisting on a 5-year revenue projections for a very early stage, relatively early stage company, it really means, and I've seen this pretty often actually. It really means that they are either checking box or checking some box to do something internally, or they just don't know what early stage investing even
They get
means.
it, yeah.
Right.
Uh, it leads to some crazy issues down the road. But I've seen that too frequently.
Yep.
So you're
Yeah.
better off, you're better off, if you're in that, pre-seed, seed, even Series A, before product market fit, you're better off talking about KPIs that are much more product centric than building these fancy. And I've seen some very, very nifty Excel models that I just love, but means nothing.
One more thing, yeah, one more thing, Vineet, which we have, again, that's one of the observations that we wanted to evidence was like, I will do in India, then I will scale in global market. People would have no clue of how the global market work, regulations, what needs to be done, everything. This is also another common trend. This is also in a way falsified, right? Because you are talking about, I will generate the rest of the revenues in the global market. See, fundamentally, you are saying that I'll postpone whatever it is.
Pavan,
My,
this
I'm
is
so yeah, so
Raghu.
yeah. So I actually will take the other side of the bet on this one, meaning at least I'm looking at most of the India ecosystem, which is actually very similar to the Israeli ecosystem. I look at it as the
Hmm.
Israeli ecosystem as the 51st state of the US, effectively, or whatever, and it's very similar to the India ecosystem. I mean, I'm talking the broader VC, not the impact, and not the sort of the second level of it, but a little bit more on the tech side. They have to have a global view, and they simply because they probably have a global experience. And yes, the problems are unique in India, but it's not so unique that other markets don't have similar problems. So, yeah, building for quote unquote India initially, but having a very clear idea, or at least some playbook, understanding of a playbook, that there are other ecosystems, other markets where these are latent problems that you can potentially go solve, uh, will definitely help you, because at the right stage, it's a very clearly defined playbook. You can find the right investors, you can find the right go-to-market help, and expand. I actually will go one step further and say, if you solve for India, you can solve for a lot of rest of the world.
Vineet,
Yeah,
how
so
do you see
Pavan,
this?
Pavan, I actually am on the Raghu's camp on this side because if you compare, every state of India is equivalent to a European country. Okay,
Right.
so then one can say one state is good enough. Why build for India? So Karnataka is good enough. We don't think like that, right?
Hmm.
Because India is one country, 1.4 billion people. So you build for 1.4 billion. You don't build for 20 million. So I think the same logic applies. If so, I think acknowledging the challenges, attracting the right talent with the right kind of experience is a different problem altogether. But ignoring the global market is a stupidity that I do not actually subscribe to. So you look at the global market, you actually, because once you come up with the product, once your product is identified, a lot of products are actually probably just replicable across the globe.
Right.
Then what you have to do is essentially build the team, and that's again where capital will play a very important role. You initially go and build a product, and you say whether there is relative. For example, you're building a product for a bank. Of course, every country will have some level of its own complication, but a Citibank is Citibank everywhere, right? So if your products work in Citibank India, it might work in other places. That's the assumption. Now, if you are actually building it for India, then you might actually be selling it anywhere else. Same thing applies to software, SaaS, and many other products. It also applied to agriculture, food products, and others.
Right.
Because if you're actually producing in India and you're selling to a market, you might sell it to Bangladesh, you might sell it to Sri Lanka, you might sell it to Indonesia, and you might sell it in Africa, you might sell it in Europe, you might sell it in US. Why limit yourself? This does not necessarily mean that you don't plan or you don't understand the risk of doing that. That's actually a separate thing. So when somebody says, I am building a global company, I would then actually diligence the company whether they have thought about these issues. It's a question in my diligence. I will also, if the person says, I will in 3 years' time, so I'm raising, let's say somebody comes to me and says, I'm raising $50 million. And the reason I'm raising $50 million is $10 million I'm going to spend in my global expansion, right? then I will dedicate some part of my time to understand how is that capital being utilized. Does this person has the understanding of the global market, etc. It's a diligence question, but I would not do anything at all to restrict the ambition of the entrepreneur.
Right. I think that makes sense. Again, to conclude this, again, this is a quite deep discussion on this. Like, would you see a VC model also changing from a pattern matching kind of a founders looking at, or to a people who are going to be probably persistent founders? Or it's already in place, especially in the impact space, because these founders already are persistent enough to solve a problem.
So, Pawan, I think one thing that you have to understand is, as I said, VCs are so money works on mandate. So, first we have to understand money itself. That's very, very important. So, money works on mandate. When the mandate comes, it comes to the GP. The GP goes and tells a story to the LP. The LP gives the money. Now, generally, as I keep saying, it is the GP who tells the story, and the LP decides or chooses to participate in that story. Then all the power rests with the GP. Okay. Similarly, when a GP goes to an entrepreneur, GP is the general partner, LP is the limited partner, and the person whose money I'm using. When I go to an entrepreneur, the entrepreneur tells me a story. Okay. And it is my choice whether I buy into that story or not. A lot of entrepreneurs forget that the investor is actually buying their story. And therefore giving them the capital to fuel as a fuel to charge their motor and take that fast. And so it is their story, not our story. So that VC said so and he said so and they said so is a stupid statement to make, because VC has no relevance. VC is listening to your story and saying yes or no. If the VC starts telling you what to do, you have your answer. This is not the right VC for you, right? So entrepreneur needs to be very clear. It is their story. They have to deliver on what they committed. Like VC has sold a story to the LP and has actually got the money. And so I have to go back to the same guy and tell him, listen, I took your money. I told you this story. I created a portfolio. It did not perform. If it didn't perform, right? I will be beaten up. I may not be able to raise my
Right.
next fund.
No, no, correct.
Similarly, so the entrepreneur has to continuously remember it is their story. The VC is participating in their story. They are not participating in VC story.
Right. I think that's a very
Say that.
it's a master class. So, Raghu, any closing
Yeah.
comments?
Yeah. So no, just to reflect on that, right? I think entrepreneurs spend so much time on at least the early stage on product market fit, right? There is also a VC founder fit. You as in the entrepreneur has a say in the type of VC they want to, or investor they want to work with. I know it's a massive challenge when you're trying to basically eat Maggie and build a unicorn. To turn down capital or to say this is not a fit, but that's part of the discipline that you need as you build the company. Just like you need that discipline to say, I will not serve this segment of the market because that's not going to help me build the startup I want to build. So it's very difficult. It's very easy for a VC to say you should turn down capital if it's not a fit. But I would really encourage founders to also think about founder investor fit as much as they think about product market fit.
Thanks, Vineet. This was amazing.